So here we have some accounts which are on accrual basis. You can see trade debtors, and in the liability section, trade creditors for both years. And if we look at the classification, trade debtors classified to gross accounts receivable, and we should find out trade creditors classified to accounts payable. Now if we now open a tax form, and we will try to convert this tax form from accrual, because those are accrual values, to a cash reporting position. So obviously the business values through there are all on a cash basis, an accrual basis, but we want to transform this back to cash. So what we need to do is we need to say, yes, we want to transform out the prior year values. Now we need to add in the GST component, because obviously there's a GST component that needs to be stripped out. We need to say what it is. The system doesn't know without reading your accounts receivable summary report, which would have a GST column, so you could see which of those, which of your payables and which of your receivables had GST associated with them. But let's just assume it's all, the full value on the balance sheet has GST. In that case, we've got 441, we've got 326, we've got 1081, and we've got 1000. So I take care of that, and then let me just explain the logic. So as I mentioned, the accounts are on an accrual basis. We've got prior year, and we can assume that the accounts receivable at the end of the prior year have now been collected during this current reporting year, and therefore we bring the cash to account, which increases the taxable income. And also in the prior year we had accounts payable, and we can assume that those accounts payable were all paid, meaning that the cash went out during the reporting year, and therefore we reflect the cash going out, which decreases the taxable income. And then for the current year, so do you want to adjust our current year accounts receivable? Of course, we haven't yet collected the cash, so we don't yet report the cash, and we take that current year cash out, or accounts receivable out, because we haven't yet collected the cash. That reduces the taxable income. And the same thing for the current year accounts payable. We haven't yet paid them, the cash hasn't gone out of the bank, and therefore we need to increase the taxable income. That essentially transforms the net income to cash position.